It's a new week, and the markets don't decide to fall out of bed this time around. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And not surprisingly, the conversation today continues the conversation we started last week, and really the conversation we've been having since the beginning of July, which is where is the bottom on stock markets, and is it perhaps already in? That conversation getting a lot more interesting this week because unlike last week's fireworks, which happened in the wake of the preceding week's data, not for any particular reason that happened last week itself, we actually have some meaningful event risk this time around. We actually have some data to consider and actually have some real catalysts that may inspire follow through. So that's where we are going to take this conversation. There is a busy economic calendar in front of us this go around. And the question that, of course, is on our minds is, are stock markets actually on the mend? Because what we ended up seeing last week was something of a wild seesaw. So we'll begin with what the markets actually did. You can see here that the S&P finishes the week last week down only 0.1%, so basically unchanged. NASDAQ ends with a gain of 0.3%, again, unchanged, which seems modest, but of course stacks up very nicely considering at one point the S&P was down 4.5%. And NASDAQ was down 6.3. So we can see here the markets managed to shrug off that Monday weakness after that initially occurs and are able to crawl and claw their way back to unchanged. Here's a chart of the S&P 500 here, and you can see exactly what occurs. So on the one hand, of course, here is the gap on Monday, sharp decline. We take a few days to digest, reverse basically just to the place where that gap occurs. We fill that gap, and now we're stalling. But needless to say, there was all of this down move ahead of where this price action occurred, and that down move took out the rising trend going all the way back to the lows in late October, early November of last year. Not surprisingly, then the question is, well, is this a bottom just because we've erased Monday's losses from last week, or are we in fact looking at something that is a stair step down? Down, lower low, correction, down, lower low, correction, whereby the next move from here is, again, this, back down. And so as we look at the performance around markets, much of the rest of the space falls into place. A slight rebound in yields, reflecting the adjustment in stock markets off the lows to these unchanged readings, about a 4.5% rise across the curve. Crude oil, again, marching to the beat of its own drum, adding 4.5% around geopolitical risks. We still have all this back and forth around Israel and Iran maybe starting to shoot at each other in a more direct way once again. Markets, of course, got a little bit of a version of this some months back. It all looked very coordinated, like the two sides didn't really want a direct confrontation. But needless to say, those kinds of coordinated things can go off script sometimes with extremely dire consequences. And so a degree of geopolitical risk, despite the fact that neither side wants, or at least appears to want, direct confrontation, that has re-entered the price of crude. Gold basically flat last week. The dollar basically flat. Even the yen basically flat, having been dramatically higher through Monday's sell-off, basically echoing what equity markets did here. And as for Bitcoin, it was down again, but perhaps a little bit less so. So perhaps the sell-off slowing somewhat, down 3.1% versus the 8.5% sell-off in the prior week. So once again, this is really the story here. And we are at the deciding line. One could envision a further correction back into the direct underside of this range around 54.32, but one way or another, anywhere between this gap, which has now been filled, and the immediate underside of the preceding range is the place where the sequence of lower highs and lower lows established since early July would be overturned. And so this is where we are going to see whether what we've just witnessed was a crescendo of selling that ends that down move and begins the next leg higher, or if the move continues. Here are then the macro waypoints that might influence this conversation going forward. The first is actually from the UK, gives us the July UK CPI report. That's 2.3% expected, which would be a bit of a pickup. That'd be the highest reading since December or the largest uptick rather since December of 2023, and the highest in 3 months. Later in the week, we're also looking for second quarter UK GDP data, where output is seen rising 0.6% in the second quarter, coupled with a 0.7% rise in the first. That would actually make for the fastest expansion in over 2 years in the first half of this year. Nevertheless, if we look at economic data outcomes as relative to forecasts, Citigroup would suggest that in the UK, the outcomes have been fading and weakening in relative terms, which suggests that perhaps analysts are envisioning a stronger UK economy than what's actually on the table. If that were to be the case, and in that we'd have the stage set for a disappointment, in particular on this UK report. The GDP one comes later in the week and is more backward looking, so it's a bit less impactful perhaps, but the tone then set by these numbers, were they to miss relative to expectations, would be a more dovish perspective on what the Bank of England may do next. Now, since about the end of last month, there's been a very cautiously hawkish readjustment in policy expectations. So we've moved just a touch here from looking at expectations for give or take 53 basis points in rate cuts to now 40 through the remainder of this year. So we've shaved off quite a bit here as we've moved through this period over the past couple of weeks. And obviously, we've already had one rate cut from the BOE. They've already kicked off this easing cycle. So if we were to get data that were a little bit on the softer side, you could see a unwinding of some of that repositioning, which most directly would introduce a further downside or renewed downside momentum for the British pound, but may likewise speak to this more considerable global recession narrative. Because as ever, if what this is has been motivated by anything, it is a tone shift at the Federal Reserve. At the beginning of July, precisely where you get this turn. This is where you get the Fed telling us they're as concerned about growth now as they are about inflation, saying there are risks to either side of these different objectives in their dual mandate have come into balance or better balance, implying essentially in their most recent policy statement that followed on July 31st, that policy meeting, that we have a situation now where the Fed is about as worried that unemployment is going to surprise higher as it is that inflation is going to surprise higher. And so, needless to say, this is a very important rethink and suggests that any incoming rate cuts are not going to be about maintenance, inflation expectations falling, and thereby the Fed rate needing to come in lest real interest rates, nominal minus inflation, were to spike up and the economy were to become a victim of the Fed's disinflation success. No, it looks like the Fed is now concerned that maybe they've overstayed at high rates and are now legitimately becoming worried that the business cycle may take a turn in an adverse direction. As we say, they began to float this idea in early July, and then, of course, that CPI report that came out then, almost exactly a month ago, acted as confirmation and kicked off this decline, which was then made official as a breakdown with that disappointing NFP report that we just saw give us that push through and then was followed by Monday's fireworks. So, if anything, soft numbers out of the UK would tell us, yes, there is a global downturn that may be gathering. Fading pricing power suggests that demand is weakening. And if demand is weakening in the US, as might be implied by what we heard from the Fed and indeed the incoming US inflation numbers, then that would be a global concern because, of course, absent the US, the other main engines of global demand, mainly in the Eurozone and in China, are misfiring. And of course, to that end, the biggest release likely to be market moving on the calendar is that US CPI report. We're expecting a slight inching lower, 3.2% on the core. That's down from 3.3 in the prior month, 2.9% on the headline, down from 3% in the prior month, both of which, give or take, would amount to 3-year lows. Now, the Cleveland Fed's inflation nowcast, which takes incoming information as it appears and adjusts its CPI forecasts day in, day out, essentially, that is pointed to an unchanged outcome. So it sees a little bit higher numbers here, 3.3 for the core, 3 on the figure for the headline. So the market is perhaps a little bit primed for an upside surprise, but of course, U.S. economic data has increasingly soured relative to forecasts for going on 4 months at this point. Mid-April is where that begins, according to Citigroup data. And of course, we've seen the consequences. The shift in rhetoric from the Fed, the reaction from the markets, the topping in equities in early July that we just saw. All of that is a function of, first, the U.S. economic data story turning dour, not necessarily in absolute terms, but certainly relative to forecasts, and the Fed recognizing this and thereby triggering the markets to onboard it as a catalyst. If that continues here and this misses on the downside, even as the markets are primed for something a touch warmer, then worries about lost demand get amplified once again. Not surprising, of course. The consumer, hence the middle of this CPI acronym, it's the consumer price index that we're looking at. That's the engine of U.S. economic growth, as it is in most developed economies. And so when we look at this and say, well, this is fading faster than expected, the concern is that it's a loss of demand in what is the engine of that demand economy wide. Now, we should get that in even greater relief toward the end of the week. Over the course of the incoming days, we're first going to get the U.S. retail sales report. The expectations there are that we're going to get a little bit of a pickup in July. And then on Friday, we're going to get the University of Michigan consumer confidence numbers. And it's the confidence numbers that are perhaps a little bit more impactful. The retail sales report is, of course, something to keep an eye on, 0.3% expected month-on-month growth, but that is a volatile series, and it is generally the sort of back and forth here in sentiment that would speak to the bigger story. Retail sales can pop, they can unravel in relatively short order of looking at month-on-month numbers. But what we see here in the consumer confidence story is actually quite telling. Sentiment begins to improve here right in the middle of 2022, which of course follows the peak in inflation expectations that very tellingly find their top in March of 2022 as the Fed begins to hike rates. As inflation expectations then march lower, sentiment improves, basically saying, well, consumers feel better, not surprising, of course, when inflation expectations decline. This is the one-year inflation expectation in the gray bars here. And you can see when inflation expectations pop, sentiment cools, like here, or here, or here. But over the past several months here, really since June, something weird is going on here, whereby inflation is cooling. You can see this pop here was another decline in sentiment, but it has since cooled off, but sentiment has not rebounded. As a matter of fact, it's stayed trekking lower, which is saying that consumers are no longer just encouraged by inflation expectations climbing down. Now they're more concerned for ostensibly broader reasons, and a weakening of the labor market and a general turn towards softer conditions might then be implied in these dynamics. Of course, this was one of the earliest indicators of the inflation situation being sticky that then activated the Fed's rate hike cycle. And so this survey tends to be quite early on what the business cycle is about to do. And so this should be very interesting to watch, of course, along with the retail sales release in the wake of CPI to say, well, if there are in fact recession fears, and if those recession fears are telling us the business cycle is in fact starting to roll over in a more concerned way than a sustained rebound in equities would demand, well, then this would be the week to see it. Now, outside of those readings, the other notables here, second quarter data out of Japan, the expectation that we're going to get a 2.1% annualized rise. That would be, as we can see here, a meaningful uptick relative to recent performance and essentially take us back into the second quarter of 2023. Now, if you notice that in the second quarter you tend to see a pop, that's probably not by accident. Outside of this COVID sell-off here, which is, of course, a special sort of situation, the second quarter does tend to have a little bit of positive seasonality in Japan because it comes right after the turn of the Japanese fiscal year. April 1st is the first day of the new fiscal year in Japan, and that can have some pickup in outlays as essentially new fiscal year money is allocated. And so there can be a little bit of seasonality there. Nevertheless, Japanese economic data has been relatively upbeat on the growth side of things. The PMI numbers suggest that even after whatever happened here in the second quarter, in the third quarter, things have held up relatively well. If we get a somewhat upbeat result here, then it might suggest that Unlike other major central banks, the Bank of Japan still intends on continuing to have a slightly hawkish bias. And so the seesaw that we saw in the yen last week may once again give way to yen strength and to some extent weigh on local markets. ETF there is EWJ, tracking Japanese equities. And finally, another batch of numbers from China. Here we're looking for a little bit of a pickup in retail sales and a little bit of a downshift in industrial production, which seemingly rhymes with the numbers we got last week, where exports were a little bit weaker, but imports better, and then a little bit of a higher CPI number came out than markets were anticipating. 0.5% year on year was that reading, and the markets were looking for only 0.3. But nevertheless, there is some smoke and mirrors here. So 7% rise in imports versus about 3.5% expected, along with somewhat stronger CPI than expected, would seem to suggest that there is better domestic demand in China. But then you take away the volatile items and the ones that are frequently imported, energy and food, and you end up with CPI of just 0.4%, which was actually the weakest since January. You then consider that the Chinese yuan in July was down close to 1.1% from a year before. It was up on the month, but of course it's year-on-year comparisons that are relevant here, so that we're looking at this apples to apples when we look at these consumption and retail numbers. And so it appears to be actually that the reason you get a pickup in imports, the reason you get a pickup in CPI is more likely to be linked to imported inflation, because the yuan is down over 1% year on year for the relevant period here, than from a pickup in demand, because indeed core inflation fell considerably once you take those factors out of the equation. So you might well see then a downside surprise on retail sales, on industrial production here, as Chinese data has tended to be doing for the past 3-4 months, which of course does not help with global recession risks, because it suggests ongoing anemic conditions in the world's second largest economy. All of which then suggests, taken together, that it is likelier perhaps that what this is a correction not unlike this one, albeit more violent, and that the path of least resistance is another leg lower. Though, of course, confirming as much will fall to price action to carve out over the course of the week. And that is macro money for today. As ever, we are here every Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go thereafter. I'm on with Victor Jones for The Price of Truth on Wednesdays, on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.